On paper, this number looks precise.
2,74,44,150.
But behind this figure lies a corporate empire
generating multi-crore rupees in profit after tax every year.
And a financial trail that doesn't add up.
Let's step back and look at the full timeline. In 2006, the declared investment in non-listed securities was just 67,000. That is also the year Pridis Entertainments Private Limited was incorporated. By 2011 and 2016, the declared value stood at 29.2 lakh rupees. This figure is exactly 1/10 of the statutory face value of our holding. Then in 2021, there is a sharp jump. The declared value rises to 2,54,54,150. But by this point, the shareholding had already expanded significantly, reaching 7,80,100 shares, with a face value of Rs 100 per share. In 2026, the declared value increases slightly to 2,74,44,150, an increase of exactly Rs 19.9 lakh. This increase corresponds to a separate entity, Fifth Pillar Media Private Limited. However, this company was incorporated on 24th December 2019, well before the 2021 affidavit, which raises a question: was an existing asset not reflected earlier? And if so, does the 19.9 lakh increase represent a delayed disclosure? Across these years, one pattern stands out. Despite changes in shareholding and significant growth in the company's financial scale, the declared value of the controlling stake in Pridis Entertainments Private Limited appears frozen, not changing even by 1 rupee. Corporate allotment records show that the initial capital was raised through allotments to various corporate entities at Rs 100 per share. These allotments were recorded in statutory filing during the early years of the company. In subsequent years, shareholding shifted through secondary market transfers. A block of 2.78 lakh shares was later transferred within the family and split equally between the son and daughter. However, the acquisition price of the shares acquired through these secondary transfers is not available in public statutory record. As a result, the consideration for a substantial portion of the shareholding cannot be independently verified from publicly accessible data. Corporate records show these shares carry a face value of Rs 100 each. That alone places the nominal value at Rs 7.8 crore. Yet the entire portfolio is declared at Rs 2.74 crore. This reflects a clear disconnect from the company's own capital structure. Let's examine how these shares were acquired. A large portion, over 3 lakh shares, came as a gift, but the majority, over 4.5 lakh shares, were purchased. However, the acquisition price of these purchased shares is not available in the public statutory records. These shares were originally issued at Rs 100 each. At what price were they later acquired? Without that information, the declared value of Rs 2.74 crore cannot be independently verified. If the declared figure represents a historical cost, it would imply that a significant number of shares were acquired at values almost half of the original issuance price. However, no explanation is provided for acquisition price, valuation method, or the basis of computation. In the absence of these details, the true financial footprints remains hidden in a black box. In 2018, the company itself valued its shares at Rs 129 each. This implies a valuation exceeding Rs 10 crore for the same holding. Then why 2026 declaration is lower than a past transaction benchmark? Probable violation of Note 3 of Form 26. The Election Commission of India regulates how assets must be valued. Form 26, Part A, Movable Assets. Note 3 explicitly commands value of bonds or shares or debentures as per current market value in stock exchange in respect of listed companies and as per books in case of non-listed companies should be given. The definition of as per books. Under the Companies Act 2013, Section 257 and 129, the books of a company reflects its audited financial statements and internet share value is determined by its net assets. That is, book value per share is equals to assets minus liability upon total number of shares. By 2024, the company reported over Rs 150 crore in net equity and nearly Rs 45 crore in annual profit after tax. This implies a book valuation exceeding rupees 78 plus crore for the same holding. And as per note 3, this figure of 78 plus crore should be reflected in election affidavit. Based on standard industry multiples, if listed, such a company could be valued between rupees 650 crore and rupees 1100 crore. The controlling stake alone could fall in the range of rupees 325 plus crore to rupees 550 plus crore. And the total stake of the Sarma family could range above rupees 1000 plus crore, as the daughter and son hold 9.15% each and the mother holds 5.99%. This represents a gap of over 365 times. The affidavit shows a single stagnant number, but follow the corporate filings and that one number fractures into a sprawling multi-crore empire of media houses, entities with minimal disclosed operational activity, tea estates and fashion brands like Golden Threads of Assam, all of which are difficult to reconcile with a 2.74 crore declaration. But the story doesn't end up with the math. When these exact forensic findings were officially submitted to the Election Commission of India, the response was staggering. On April 8th, the Additional Chief Electoral Officer responded in writing. They officially stated, "The issues now brought forth do not fall within the purview of this office. As such, no further examination or verification can be undertaken." The Election Commission officially admitted on paper that they do not have the power or the purview to verify the true value of a multi-crore corporate empire. An election affidavit is a sworn statement. It is meant to present a true and transparent financial picture. But when the underlying basis is not disclosed, and if the Election Commission cannot verify the numbers, what are voters being shown?